All right, welcome back. Now, let's talk about Section 179. Now, here's the thing, right? Everybody knows that bonus depreciation in 2023 is now 80%. Next year, it's going to 60%, and then it's going to 40%. Oh my goodness, right? And a lot of people are like, oh, let me buy a car. Can only write off 80% of the car that's more than 6,000 pounds, and all of these shorts and reels and all this misinformation that you see. Well, it's not really misinformation, but the way they talk about it, like, hey, any car can be written off and so forth, and it's only 80%, bonus depreciation, disaster. No, let me just stop you, right? Let's think about this for a second. If you're buying machinery or equipment for your business, okay, materials for your business, I don't know, office equipment, whatever that may be, you can still use a Section 179. Section 179 has been around for a while, and you could still take 100% depreciation deduction on your equipment that you buy in the business. I'm not talking about the vehicles, okay? We're not talking about the vehicles today. We're talking about equipment, okay? As long as it's under a certain threshold, I think for 2023, it's like $1 million and change. As long as the equipment, all of that total is under $1 million, you can take 100% deduction. You don't need to necessarily start using bonus depreciation and only be limited to 80%. Another thing about bonus depreciation, what a lot of accountants don't seem to understand, because I've seen those mistakes on the returns, is that when you take a bonus depreciation on certain equipment, some states do not allow bonus depreciation. I'll speak, for example, for the state of New York, since I'm from New York. When you take a bonus depreciation, whether it was last year of 100% or this year of 80%, state of New York says, nope, we don't recognize that. We're going to add it back to your income, and we'll take a regular depreciation, whatever that may be, 5 or 7 years, okay? And if you just unclick the bonus depreciation box on your tax return and click Section 179, it will be allowed on the state as well, right? So really you have to strategize, okay? Obviously you don't have to prepare your own return to check off the box. You've got to speak to a tax advisor, okay? Make sure you do this with a tax advisor. Buying equipment before year end is a huge tax strategy. I'm not saying buy equipment that you don't need. Like a lot of people, I get a call sometimes from clients are like, hey, can I just go ahead and buy a car and buy it in equipment? I'm like, well, do you need it? Not really. I just want to get a tax deduction. Don't buy it, okay? Don't buy it, because next year, if you end up not using it and you want to sell it, you're going to have what's called a depreciation recapture, pay the taxes back. Why do you need that headache, okay? Only buy equipment if you need it. Now, I always ask my clients, hey, is there going to be an equipment next year that you're going to buy and you're going to need it next year? They're like, yes. I'm like, all right, let's talk about and let's strategize if you need to buy this year instead. Maybe bonus depreciation of 80% might help you, or Section 179 and 100%. How do we approach that? Will you be in a higher bracket next year or in a higher bracket lower year? So definitely speak to your tax advisor. But you can certainly take advantage of Section 179 to take 100% deduction on equipment or any similar items. Now, the next top 5, okay, loss harvesting. Interest rates went up this year. Stock market has not been doing as great. A lot of people have lost the money on their stocks. Now, we have this law that if you buy any stocks at a loss, what happens? Let's say you lost $100,000 on the stock market. You can only deduct $3,000 in the first year, and then every year going forward, it just gets carried forward. Wow. Now, this law, I believe, was enacted. This limitation was enacted, if I'm not mistaken, sometimes in the 1980s, I think, okay, and has never been adjusted for inflation. So if you lose $500,000 in a stock market and you don't have any other gains, like to offset those losses, then the only deduction you can take is $3,000 this year, $3,000 next year, and so forth. Loss harvesting, meaning like, hey, how can I harvest my losses? If you've got a portfolio of stocks that you have a gain and stocks that you have losses, and if you were thinking about selling these stocks that have losses, remember, you will only be limited to $3,000 losses unless you also sell stocks that have a gain. Let's say you've got an unrealized gain of $100,000. Then you have an unrealized gain of an unrealized loss of $90,000. So if you sell your portfolio with a loss of $90,000 of your stocks, you only can take $3,000 deduction. But if you sell $100,000, make a $100,000 gain on this stock, and sell this one at $90,000 loss, you can take the entire $90,000 against that gain. That is called loss harvesting. Now, don't go out, start selling stocks and all of that stuff. Definitely speak to your tax advisor because this is super, super important for you to save money on taxes. As a business owner, you always want to look for strategic ways to be able to save money on taxes, okay? Super, super important. Don't just work with a tax preparer that puts the right numbers in the right boxes. What you need is a tax advisor. All right, let's talk about buying another business and then prepaying expenses, and we're going to talk about that right after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other business owners just like yourself, or better yet, subscribe to the channel would be much appreciated. Thank you again. Now let's get back to the tax strategy. All right, welcome back. Let's talk about the last top 5 tax strategies, the last 2 of the top 5, which is buying a business and prepaying expenses. Now you might be like, Boris, why do you have a tax strategy of buying a business? And you know, I've been talking to a new client of ours for tax advisory, and he's like, hey, listen, Boris, I don't know what the hell happened. I made tons of money this past year, and I'm looking at a big profit. So despite of all the strategies that we came up, he's like, Boris, what if I buy another business? How is that going to work? And I'm like, you know what? That's a great idea. Let's brainstorm. Now, he took a proactive approach, right? He got a tax advisor and he spoke to a tax advisor instead of going into it blindly. So let's talk about how buying another business can actually save you money on taxes, or will it? Okay, so here's the thing. There's 2 types of purchases, and I made a detailed video about this recently, so it should be somewhere in the link below. But there's 2 types of purchases. There is something that's called an asset purchase and a stock purchase. Stock purchase, let's just get that out of the way. Stock purchase is just like you buying a stock in a stock market. Okay, you bought a stock, you're not going to write off what you bought. Okay, so you're just buying a stock purchase, right? A stock in that business. That's it. You acquired the entire business, you bought a stock, that's it. Now there's something that is called an asset purchase, where you're buying a business with all of its assets. And that is really, really important, because it could be a huge tax strategy for you when you're buying a business. Because remember, if it has assets, those assets could qualify for what I said earlier, for either Section 179 or bonus depreciation of 80% or 100% if we use Section 179. That depends. It really depends how the purchase agreement is structured. A lot of times, I advise my clients, hey, make sure 2 attorneys on both sides talk it to each other. The purchase agreement should have a list of assets. Sometimes they say, yeah, equipment, this, one thing, another, like they're very short. We have them break it down, because then we want to use that information to our advantage to write it off. Because if you're buying a business with assets, those assets could be a write-off for you, even at 100%. Let's say you bought $1 million business, okay, got $1 million, let's say it has a goodwill of $300,000, $700,000 worth of assets. Well, can all those assets be written off? Yes, they may be. Okay, it also depends how much equity you have in the business and how much you put that into that business when you bought it, how much you financed to buy this business. There's a lot of things obviously play into this equation, but you can do this with a tax advisor. That's exactly how we strategize with client. He's seller financing it, almost the entire purchase with a little bit down. And I said, hey, with a little bit down, you might not be able to deduct all the equipment that you're going to buy there. How about we strategize in how we can put in more of your money into the business to create that basis to be able to take those deductions, okay? This is a strategy. He was so blown away. He's like, man, this is amazing, right? So he's looking to, on top of all the tax strategies that we did in the tax plan, on top of all of that, he's now going to be like buying another business. And obviously he's an educated person, so I'm not just saying go ahead, buy any business that there's out there and so you can save money on taxes. Never do that. But this client happens to be an educated person about buying that business, and he's done his due diligence. So I thought this was an amazing strategy to share with you guys. Last but not least of top 5 is prepaying your expenses. Now, can you prepay your expenses before year end? Great strategy, but you got to be cautious, okay? Now, when I say you have to be cautious, what does that mean exactly, okay? First of all, remember, when you're prepaying your expenses, you're basically saying, I'm not going to pay them next year. So you may not have those deductions next year. You may take them all this year. And that's totally okay if you have a strategy behind it. In some cases where I advised clients on this tax strategy, I said, hey, use this strategy if you're going to be in a higher bracket this year than next year. Because sometimes it happens that certain business owners in certain industries, right, they get some big client this year, like big client paid a lot of money, or big project or big contract, and they got paid really hefty for it. Like, yeah, I am not having that project next year. I'm not having that contract next year. So on a lot higher bracket this year, we need to make sure we need to see how we can lower the taxable income legally this year with prepaying some of the expenses. Now, can prepaying expenses also hurt you? Yes, prepay too much expenses. You're in the same bracket this year. Next year, you're not going to have that expense next year unless next year you prepay again. Okay. Another thing that I've heard people say, oh, I receive checks from customers, but I'm not going to deposit them. I'll wait until year end. That's what my friend did. Well, the IRS says if the money is already in your possession, that is considered income. Okay, it may not be deposited, but it's considered income. So don't be one of those people, because you will also not only, first of all, not being compliant, but at the same time, you're pushing this income to the next year. Are you going to be in a higher bracket next year, lower bracket? What's your strategy behind it? Okay, what's your strategy behind prepaying expenses? That's why prepaying expenses, whatever that may be, some type of this strategy, speak to your tax advisor. Don't just go ahead and do it by yourself. Any tax strategy, anytime you want to save money on taxes, it's good that you get educated and you check out the videos online and watch Boris's YouTube video. Okay, that's totally normal. But when it comes to implementing tax strategies, especially because you are a profitable business owner, I always recommend work with a tax advisor. Not just tax preparer, not somebody who puts the right numbers in the right boxes, and God forbid if your bookkeeper is your tax preparer. Okay? Anyways, I hope this was really helpful to you guys, and till the next time.